How do you invest in a market that seems to be constantly in flux? With stocks swinging up and down, the volatility can feel overwhelming. But can you still make money in the middle of all this uncertainty? If you're wondering how to navigate the chaos and still build wealth, you're in the right place. In today's video, we'll explore 8 simple yet powerful rules that can help you survive stock market volatility and even thrive in it. You don't need to panic or jump in and out of the market. These strategies will allow you to stay on track, build your portfolio, and ultimately come out ahead. Let's dive in. 1. Reassess your risk tolerance. When the market is in turmoil, your first instinct might be to pull back. But instead of reacting emotionally, it's time to reassess your risk tolerance. The first rule for surviving market volatility is not to panic or sell off your investments at a loss. Instead, take a step back and evaluate whether your current investment approach aligns with your actual comfort level. If you're feeling anxious seeing your portfolio drop, it's a sign that you may need to adjust your strategy. When markets are thriving, it's easy to feel like a risk taker, but when volatility hits, anxiety can set in, especially if your risk tolerance doesn't match the level of risk in your portfolio. Take the time to do a self-assessment. How much volatility can you actually handle without stressing out? It's important to align your investments with your true comfort level, and this will help you avoid making hasty decisions. For example, if you've been investing in high-growth tech stocks that are extremely volatile, but you're feeling uncomfortable, it may be time to scale back on those and add more stable, defensive assets like bonds or dividend stocks. By reassessing your risk tolerance, you ensure that you're set up for long-term success, even during market dips. You're also giving yourself permission to avoid panic moves, which can cause long-term damage to your portfolio. 2. Consider defensive assets for your portfolio. The second rule for managing volatility is to ensure your portfolio has enough defensive assets. These are investments that don't experience as much volatility and are designed to protect your portfolio during downturns. Think of these as the safety net in your investment strategy. Defensive assets include things like U.S. Treasury bonds, high-grade corporate bonds, and consumer staples. These assets tend to be less affected by market fluctuations, offering a stabilizing effect in a rocky market. For example, bonds typically don't swing as wildly as stocks do, and while they may not deliver the explosive growth that high-risk investments like tech stocks can, they offer steady returns and reduced volatility. By incorporating more defensive assets into your portfolio, you can reduce the overall risk during periods of market turbulence. For instance, if you're heavily invested in equities, consider shifting some of your funds into bonds to create a better balance. This ensures that even when stocks are bouncing around, you have a more stable foundation beneath you. Defensive assets help you protect your gains and keep your portfolio in the green, even when the market is in a downtrend. 3. Stop focusing on paper losses. Focus on percentages. It's easy to get bogged down by paper losses, especially when your portfolio value dips. If you're watching your investments drop, you might think, "I've lost $5,000. But here's the key: you only lose money when you sell. What you're seeing is simply a paper loss, a temporary drop in your portfolio's value. Instead of thinking about the dollar amount, shift your mindset to focus on percentages. For example, if your investment drops from $100,000 to $90,000, you might feel like you've lost $10,000. But looking at it in terms of percentage, that's just a 10% drop, not as emotionally overwhelming when viewed this way. It helps you detach from the number and think about the overall picture. Moreover, the stock market is inherently volatile, and it's common for prices to fluctuate. As long as you don't sell when prices are low, you haven't actually lost any money. These dips are a natural part of market cycles, and as long as you're investing for the long term, those paper losses will likely be reversed. Keep a focus on percentages, and you'll reduce emotional reactions to short-term swings. 4. Keep investing consistently. One of the most common mistakes investors make during volatile times is trying to time the market, jumping in and out based on short-term fluctuations. The problem with this approach is that it's nearly impossible to predict when the market will rebound after a drop, or when it will fall after a peak. This is why consistent investing is crucial. Instead of trying to time the market, stick to your regular investment schedule. Whether you invest weekly, bi-weekly, or monthly, keep that rhythm going regardless of market conditions. Over time, this strategy will help you average out the highs and lows, so you won't be as affected by short-term market volatility. Even better, automate your investments so that they happen without you having to think about it. Set up automatic contributions to your investment account and let the power of consistent investing work for you. By doing this, you'll capture the long-term average returns of the market, even through periods of volatility. 5. Keep a long-term perspective. Another key rule for surviving market volatility is to zoom out. When you focus on the short-term fluctuations, the market can feel overwhelming and unpredictable. But when you look at the bigger picture, over a year, 5 years, or even decades, you'll see that the stock market has a long-term upward trend. Yes, volatility is part of the market cycle, but if you keep a long-term perspective, you'll understand that these drops are just small bumps on the road. The goal isn't to avoid all market drops, but to weather them and stay focused on your long-term financial goals. Remember, even during volatile times, the overall trend of the market has been positive, and history shows that markets recover from downturns. When you take a step back and look at your portfolio over a longer horizon, the emotional impact of market swings lessens. You won't get distracted by every headline or daily fluctuation. Instead, you'll stick to your plan, knowing that over the long term, your investments will grow. 6. Invest through volatility, not around it. Volatility presents opportunity, something that many investors miss. It's easy to get scared when the market dips, but this is actually the time when many successful investors make their moves. Consider the market drop in March 2020. Many investors sold off at a loss, fearing that the market would never recover. But those who stayed invested or even bought the dip were able to ride the recovery and see huge gains. Instead of running from volatility, learn to see it as an opportunity to buy quality assets at a discount. When the market drops, solid companies and undervalued assets become even more attractive. This is where long-term investors make their biggest strides. By staying calm and taking advantage of volatility, you can grow your wealth faster. 7. Diversify your portfolio. Diversification is the cornerstone of a solid investment strategy. Instead of putting all your eggs in one basket, spread your investments across different asset classes, sectors, and regions. This will help reduce the risk that one poor-performing asset will drastically affect your overall portfolio. When you diversify, you protect yourself from significant losses during market downturns. For example, if one sector, like tech, suffers during volatility, your investments in other sectors, like utilities or bonds, may remain stable or even grow. The more diversified your portfolio, the more resilient it will be when the market experiences sudden drops or volatility. 8. Keep your emotions in check. Finally, one of the most important tips for surviving stock market volatility is emotional discipline. The market can be emotional, with prices swinging wildly based on news, speculation, or external factors. But it's crucial not to let your emotions dictate your investment decisions. Fear and greed can lead to rash decisions, such as selling off your portfolio in a panic or chasing after risky investments hoping to recover losses. Stay calm and focused on your long-term goals. If you find yourself feeling anxious, take a step back and remind yourself of your strategy. Trust the process, and remember, the stock market has a history of bouncing back after volatility. And there you have it, 8 simple rules to survive stock market volatility. Whether it's reassessing your risk tolerance, diversifying your portfolio, or simply maintaining a long-term perspective, these rules can help you stay calm, confident, and in control, even when the market is unpredictable. If you found these tips helpful, don't forget to like, share, and subscribe to our channel for more strategies to help you grow your wealth. Investing doesn't have to be stressful, and with the right approach, you can come out ahead, no matter what the market does. Thanks for watching, and I'll see you in the next video.